The Fed is trapped. How the Iran oil shock just killed rate cuts and what it means for your money. The Federal Reserve just admitted it cannot cut interest rates, and an oil shock from a war in the Middle East is the reason why. Yesterday, the Fed held rates steady at 3.5 to 3.75%. That part, nobody was surprised by. But here's what the market wasn't fully prepared for. The Fed's own updated forecasts now show inflation running hotter than expected, the jobs market softening faster than hoped, and a leadership succession that is, right now, legally blocked in the Senate. In this video, I'm going to break down exactly how a military conflict in Iran pushed the world's most powerful central bank into an impossible corner, what the Fed's own dot plot is actually telling you versus what the headlines say, and which assets are most exposed in the weeks ahead. This is the most important macro story in markets right now, and most coverage is missing the full picture. The oil shock that changed everything. Let's start with the trigger, because everything flows from this. On February 28th, the Iran conflict escalated significantly. Within days, Brent crude futures crossed $95 a barrel. By this week, they hit $109 intraday, a move that took oil up roughly 15 to 18% in under 3 weeks. Now, why does that matter for the Fed? Because energy prices feed directly into the inflation data the Fed watches most closely, the Personal Consumption Expenditures Index, or PCE. Before this oil shock, the Fed's December forecast had headline PCE inflation at 2.4% by year-end. Their new March forecast, 2.7%. That is a meaningful revision upward, and it happened in just 3 months. What that means in practical terms, every time you fill up your car, every time a trucking company delivers goods to a supermarket, every time an airline prices a ticket, those costs go up with oil. And those costs eventually show up in the prices you pay for everything. The Producer Price Index for February, which measures what businesses pay before they pass costs to consumers, also came in hot last week. That's a leading indicator. It tells you what's coming for consumers in the next 60 to 90 days. So the Fed walked into its March meeting already looking at an inflation picture that was getting worse, not better, and oil was the reason. The impossible dual mandate, the stagflation risk. Here is where this story gets genuinely complicated and genuinely alarming for investors. The Federal Reserve has 2 jobs. Keep inflation near 2%, keep unemployment low. Those 2 goals almost always pull in the same direction. Almost. Right now, they are pulling apart. On the inflation side, energy prices are pushing costs higher. Core PCE, which strips out food and energy, is running at 2.7% too. The Fed's own projections confirm we are not at target, and we're moving away from it. On the employment side, payroll readings have been weakening. Chair Powell himself acknowledged in yesterday's press conference that the slowdown in hiring reflects lower demand for labor, not just a drop in immigration, as he suggested. White-collar job postings are softening. That's a warning signal. Now, the word nobody wants to say out loud, but the market is clearly thinking, is stagflation. Stagflation is what happens when an economy faces rising prices and slowing growth at the same time. It's the nightmare scenario for a central bank because you literally cannot fix both problems with the same tool. Cut rates to stimulate growth, inflation explodes. Raise rates to fight inflation, you accelerate the slowdown. Hold steady and wait. That's what they did yesterday. And the Dow fell 768 points in response. Powell pushed back on the stagflation label at his press conference, saying, and I'm paraphrasing here, that we're nowhere near the double-digit unemployment of the 1970s. And he's right that the base conditions are different. But the structural tension he described is real. Higher energy, a softening labor market, and a Fed that has very few good options. That combination is what's making investors nervous. The dot plot decoded. Let's talk about the dot plot, because this is where the real information lives, and most people gloss over it. The dot plot is the Fed's summary of economic projections. every meeting, each of the 19 Federal Open Market Committee members anonymously marks where they think interest rates should be at year end. You read the median, the middle dot, to understand the Fed's collective view. Here's what December's dot plot showed: one cut in 2026. Here's what March's dot plot showed: still one cut in 2026. But the distribution shifted. 7 of the 19 officials now expect 0 cuts this year. That's up from 6 in December. One more member quietly gave up on cuts altogether. And the timing on that one cut? Before the Iran conflict, markets were pricing June as the most likely window. As of today, CME FedWatch data shows that probability has collapsed. Traders are now pointing to September or October at the earliest, and even that is not guaranteed. What this means practically: borrowing stays expensive. Mortgage rates stay elevated. Corporate refinancing costs stay high. And growth assets, particularly long-duration tech stocks, continue to face headwinds from the discount rate. The Fed essentially told markets, "We believe this energy inflation is transitory," that once the Iran situation stabilizes, oil falls back and inflation cools. They're betting on that outcome, but they're not willing to cut rates to confirm that bet. That's a wait-and-see posture, and historically, when the Fed waits, markets price in uncertainty. Yesterday's sell-off was that pricing happening in real time. The leadership wildcard nobody is talking about enough. And now for the part of this story that adds a layer of uncertainty on top of everything else we've just covered. Jerome Powell's term as Fed chair ends on May 15th. That is less than 2 months away. In January, President Trump nominated Kevin Warsh to replace Powell. Warsh is a credible pick. He served on the Fed board during the 2008 financial crisis. He understands markets, and Wall Street views him as a stabilizing choice. But here's the problem. Senator Tom Tillis of North Carolina, a Republican who sits on the Senate Banking Committee, has publicly vowed to block any Fed nominee until a Department of Justice investigation into the Fed's building renovation project is fully resolved. That DOJ probe was itself challenged in court last week, with a judge quashing grand jury subpoenas, and the DOJ has said it will appeal. So we have a sitting Fed chair who has said he won't leave until the investigation is, quote, well and truly over, a nominee who may not get a Senate confirmation hearing in time, and a real possibility that Powell serves as an interim chair beyond May 15th while all of this resolves. Markets do not like uncertainty at the best of times. Markets really do not like uncertainty at the central bank when inflation is running above target and a war is affecting global energy supply. The practical risk here is not that policy goes off the rails. Institutions have continuity mechanisms. The risk is that every Fed decision for the next 4 to 6 months carries a political asterisk that makes it harder to read the signal clearly. And when signals are hard to read, professional investors get defensive. That defensiveness is part of what's weighing on equities right now. So, let's bring it all together. The Federal Reserve held rates at 3.5 to 3.75% yesterday and will almost certainly hold again at its next meeting in May. The Iran war has sent oil above $109 a barrel, pushing the Fed's own inflation forecast higher, from 2.4 to 2.7%, and killing the June rate cut that markets were counting on. The dual mandate is under genuine strain, inflation moving up, employment moving down. That is not stagflation yet, but it is the early warning setup that stagflation watchers are monitoring closely. The dot plot shows 7 of 19 officials now expect 0 cuts this entire year. The earliest realistic cut window is September to October at best, and layered on top of all of this, a Fed chair transition that is legally contested, a nominee whose confirmation is blocked, and a political backdrop that adds noise to every policy signal between now and year-end. The takeaway for investors: this is not a one shock and it's over situation. The macro environment has structurally shifted over the past 3 weeks. Higher for longer just got its expiry date extended again. If this breakdown helped you understand what's actually happening with the Fed and why yesterday's decision matters beyond the headline, please give this video a like and subscribe our channel. We break down the stories that move markets every week without the noise. Hit the notification bell so you never miss an update. Everything in this video is for educational and informational purposes only. This is not financial advice, and I am not a financial advisor. Please always do your own research before making any investment decisions. Past performance is never a guarantee of future results. Always consult a qualified financial professional before investing.